We'll be doing a different format today, and this presentation will be more conversational. So we'll be taking your questions throughout the webinar. Thanks so much for joining us today, Kaysi.
Maggie, thank you so much for having me. It's such a fun, and I'm looking forward to this presentation.
Great. Okay, so we will get started with our first question. Again, if you have questions throughout the presentation, you can use the chat box here or email info@savvyladies.org. So Kaysi, the first question for you is asking how important is planning, not just from a financial perspective, but from a risk perspective as well.
Thank you. So planning is extremely, extremely important. And especially as we are going through the pandemic season, I think those people who had a plan in place realized just integral it was to their peace of mind. So when they're looking at all their, not just financial plans, I think it's life plans as well. The things that they were hoping to accomplish, wanting to accomplish, and having a plan in place, even when things get derailed, they can go back to the plan and say, okay, where am I? What do I need to do? And to continue to relook at the plan. So financial planning just goes so far to allowing people to individuals to have peace of mind as they're creating what their financial life should look like.
Mm-hmm. And you mentioned having peace of mind, and that brings up in my mind an emergency fund for situations like this. So how can someone create an emergency fund based on their current income? Maybe their income has changed. And do you have an idea of how much what time frame an emergency fund should cover?
Absolutely. So it's always best to start planning before the emergency, right? But now we're in the situation. So what we're going to do is look at where we are currently. If you're still earning an income, to figure out how can I cut expenses if I need to cut expenses, or how do I save more? And typically, the Financial Planning Association tells you that for a married individual, you should have about 3 months of savings, because typically there are 2 incomes, and if you lose one, you'll still have time to be, another person will be able to contribute to the bills and whatever else you need to pay. On the other hand, if you're single, you should look to have about 6 months of your expenses saved, and expenses being the bare necessities. What would I need to get by? So food, very important, whether it's a mortgage or rent, looking at things that you absolutely would need and wouldn't be able to cut out if an emergency were to arise.
Mm-hmm. Okay. And given everything that's going on these days, would you say it's a good time to be using credit cards for daily living expenses?
So I would not recommend using credit cards if you can avoid it, especially because interest rates on credit cards are typically so high to be able to borrow from them, and they accumulate on a daily basis. So whatever your balance is, if you're not paying it off in full each month, it's growing. So if you are only paying the minimum balance when you borrow, your bill is going to be a whole lot bigger, and over time you're going to end up paying a lot more in interest for that one item. So as much as you can avoid using credit cards, I highly recommend that.
Mm-hmm. Okay. What about stocks? Can you talk a little bit about buying stocks right now?
So I would never give specific guidance on whether it's a good time to buy or not without knowing an individual circumstance, because there's so many factors to consider, right? Especially where we are in market cycles. We're almost at record highs for stocks. There's an election that's around the corner that anything can happen based on the immediate outcome. And it's always important to look at what your time frame is as an investor. So, I wouldn't be able to give guidance on whether it's a great time to buy or not. It's really looking at your personal situation, and that's why it's important to speak with a financial advisor and someone who understands what your situation is and what you're looking to accomplish and the time frame for that.
Mm-hmm. Okay. We just had a question come in over chat, which is saying, I'm 60 and planned to retire at 62. My IRAs and 401ks are managed as moderate risk and for growth, 20 plus years as a retiree. Do I need to change my strategy if I decide to retire next year instead of waiting for 2 years?
Again, this is something that without knowing, so as many details as was provided, I would still not be able to give overall guidance on that without getting more in depth with what should I be looking for, what are other assets that are out there that the client has. So there's so many different factors that go into the decision as to should I change the strategy now because you're planning for the long term. And typically, especially females, the life expectancy is about 93 years old. So if she retires at 61 or 62, you should be planning for about 20 to 30 years of assets to be able to spend in retirement. So without knowing all the details, and I'm happy to have a conversation afterwards to be able to provide that guidance.
Mm-hmm. Okay, thank you.
So I wish I could give more details than that, but I think, just prudence says, let's have a conversation so we can get more in depth with what's specific. What are your goals? What are you looking to accomplish for these monies?
Mm-hmm. Okay. Can you talk a little bit about the difference between stocks and bonds and thinking of those as two? I think sometimes people think bonds are safe and stocks are risky, but can you talk a little bit more about the difference between those?
Absolutely. So those are two asset classes that are out there. And stocks typically are considered more risky than bonds. Bonds, when I was learning it at 2025, it said for safety, liquidity, and income. So you wanted to be able to put money away over a long time frame, and you would get the interest from it. It shouldn't move the principal balance very much, and you would collect at the end of the day, whatever the term of the bond was, you'd still be able to collect the principal, but having collected the interest along the way. Stock is a little bit different, or a lot different, and definitely will give you more potential for growth over time, but it also involves more risk. And it depends on whether you're owning an individual stock or owning a portfolio of stocks, which can either be a mutual fund or an ETF or different ways of packaging a portfolio of stocks. So each of them has some level of risk, and the traditional way of thinking is that bonds will have less risk than stocks. And again, stocks are for longer term investors that are willing to, market cycles prove over time, history has shown that over the long term, stocks will do better than pretty much most other asset classes, or the traditional asset classes anyway.
Mm-hmm. Okay. Let's talk a little bit about investing and saving for family. So are there some other types of planning that someone can be thinking about when they think about family planning?
Absolutely. So there's the individual planning, and then when we have kids, we start thinking about their college education. So we create 529 plans. And we also have to start thinking about what would happen if we're not around to take care of them. And I know that's a hard thing to think about, but this is, and I just see it so much in my profession where when the planning has been done, it gives, again, peace of mind to that. So there is insurance planning. If something were to happen to me if I were to pass away unexpectedly, and there are life insurance proceeds, your family would likely be taken care of in those instances. There are other types of insurance that would cover you for, if you were unable to work or work for an extended amount of time. So long-term care, if you got older and you ended up in a nursing home, or you wanted to have help provided at home, again, that's planning. And you're not sure if, if you have kids or you don't have kids, who would take care of you. And then on the bigger picture side is the estate plan, creating a plan for, for yourself, or having an attorney draft documents to say what happens if either I'm not around or I'm incapacitated and I can't take care of my own finances. What do I need to do in those instances? And speaking with an attorney, speaking with your family as best as you can to share about what you would like to happen is very, very important.
So how could someone leave a legacy for their family? I think that's something a lot of people, as you just mentioned, wanting to take care of that next generation. But if someone really doesn't have a lot of money right now, is there a way to leave a legacy for family?
Absolutely. It's right now taking care of what you need to take care of, right? Making sure that there aren't a lot of debt that you're potentially passing to your family members. If you're eligible for insurance, to buy insurance for, if you were to pass away. And there are different types of insurance, right? So there's term insurance that will cover you for a certain time frame, and then you'll get that, or your beneficiaries will get that dollar amount if something were to happen to you. There is universal life that's less expensive than whole life, and whole life. Typically, people know about two types of insurance on the life insurance side. It's either term or whole life. And whole life, as it says, will cover you for your whole life. That's also can be partly an investment vehicle. But again, making sure that you're pretty much covered until 120 or age. So it's doing the necessary planning while you can, to be able to say, I would like to leave this amount of money for my children or for my family, and what that looks like.
Okay. Switching gears a little bit, this question came in over chat, and it says, I have more money in a savings account than what's needed to cover about 3 years of expenses. What's a first step I can take to diversify my savings?
Absolutely. So the person said 3 years, which I think I mentioned 3 months, if that's what the question read.
Oh, maybe I read it wrong. I think it's saying in the savings account, it covers 3 years. So more than what's kind of needed for that 3 months, right? It's right. 3 years worth.
Okay. So there's having money in an account for savings. But then what do you do when you have excess money in your savings account? And this is where, again, depends on the individual circumstances, that you can invest and start looking at other types of investments. So is it bonds, CDs, stock investments in a stock portfolio? Is that the right thing for the next step? Because, history has also proven that cash will not earn you a whole lot of return on your money. So having your money safely in an account, again, while it's safe and it's covered up to, as an individual, $250,000 by FDIC, or $500,000 as a couple, it's not going to earn you very much. Interest rates are at historical lows now. So if you're earning 1%, which is low to begin with, and it's even lower than that typically in most banks, your money's not growing. So this is where you start looking at other types of investments. And again, we're talking to an investment professional is important for you, because then they'll start asking you questions about what are you looking to accomplish. And anyone that you speak with should be very interested in what are your goals, what are your risk tolerance, to be able to give you guidance.
So if someone has money set aside in a savings account, they should be thinking of having a separate retirement account. Is that correct? Kind of having different goals for different accounts? Yeah,
so we call them buckets, right? And typically different buckets will satisfy different needs. So the emergency fund that I talked about was the short-term bucket. If something were to happen to me today, how would my bills be taken care of? If something were to happen unexpectedly, would I be able to cover these expenses? Then there's the medium term bucket. What am I trying to accomplish in 3 to 5 years? Am I looking to buy a house? What buy a car? Whatever, so are the goals on an individual basis. All of us are individuals, and we just have our own specific thing that's important to us. And then the longer term, and especially if you're 40 or 50, looking at retirement and where you stand in retirement. So having different buckets, and especially when the firm that you work for provides some kind of retirement account for you where you can contribute and they'll match, it's very, again, hugely important and hugely beneficial to taking advantage of that. And there are also different advantages from a tax perspective, because personal assets, when you take them out, don't really have larger tax implications. But if you only had money saved in a retirement account and you're 40, this year's an unusual year because of what the government is allowing you to do. But typically, if you're 40 and you have an emergency and you don't have any emergency savings, and you were to take money out of a retirement account, you would have to pay the taxes and the penalties. So different tax consequences for different buckets of money.
Mm-hmm. Okay.
I hope that answered the question.
I think so. Yes.
Okay.
We had a question that came in over email, and that question saying, I'm a 45-year-old and recently divorced. I lost my home, and now it's me and my 8-year-old son who I have to plan for. What's the best and aggressive way to plan for retirement? I have very little in savings, but zero debt and make a decent salary.
So that's a great question. And just to share as well, I'm also divorced, and I have an 8-year-old daughter, so I can totally understand and relate to your situation. There are so many other nuances of what we would talk about, and I'm happy to have a one-on-one conversation with you to see if I can point you in the direction. But planning in this form is a little bit hard, not knowing all the circumstances. Okay. And I'm always careful when I hear the term, what's the most aggressive way? Because there's so many different ways to be able to answer that question without knowing the specific circumstances.
Mm-hmm. Kaysi, I'm going to share your information here just so everyone has enough time, and we will send this out as well. But if anyone wants to take note of this now, as Kaysi mentioned, to reach out to her with follow-up questions. Another question that came in, and I'm going to just mention that I think a lot of people feel like they're a little late to the game when it comes to planning for retirement. So I like that this question saying, I'm single in my 50s and late with planning for my retirement. What suggestions can you offer for late planners? And I think this is something that a lot of people are curious about.
Yeah, I mean, that's a great question. I don't think retirement planning was talked about as much as it is now. So the government does offer, if you can afford it, certain tax benefits to putting away more, even starting at 50. So typically a 401k plan will allow you to put, I think it's 19,000 this year, might be 20,000. I'd have to double check that, I apologize. But it also allows you to put away $5,000 more. It's called a catch-up contribution. So if you're able to put away an additional $5,000 each year until retirement, that will be hugely beneficial if you're able to do that. And again, also making sure that your accounts are invested in the way that you want it. And while I always reference the retirement account, on the other side, there's personal. So if you're able to put away hypothetically $25,000 in your retirement account, and there's a tax benefit for that, if you're making decent money and you can afford to save more in your personal name, you should be doing that as well. And looking if there are any expenses that you can cut if you needed to save more, and how to do that over the next few years. Something else which some people are excited about and some people aren't is, do I need to delay my retirement for a couple of years, while I either save more or just I don't have to start drawing on my retirement assets at that point. So at 60, hypothetically, if you were thinking of retiring at 65, can I work 2 more years so that I will have 2 more years of income? I can potentially save more over those 2 years, but I'm also not drawing because I didn't stop working. I'm not drawing from my assets for another 2 years. So again, these are things that, to speak with a financial planner on to be able to get specific solutions for you.
Mm-hmm. Okay. For someone who wants to save for retirement, but they're also dealing with credit card debt or other types of debt right now, is there a way to manage savings, also paying off debt? Should one be prioritized? Or what are some tips that you have for both saving and paying off debt?
I love that. That's a great question. And I think a lot that many people find themselves in, right? Mm-hmm. And unfortunately, the answer, it depends. It depends on what your goals, what your values are. It's like, oh my gosh, do I just want to be rid of debt? And I've heard, and I don't agree with this, but there's, someone who's very popular out there that's saying you should only have $1,000 saved if you have debt because you need to pay the debt first. I don't agree with that. I believe in having some kind of peace of mind where I know that if something were to happen to me, I would have money in the bank that I would be able to take care of those expenses. So it becomes almost a balancing act where you can work, you might save less and pay towards your credit card because, again, the credit card is costing you interest the longer it goes out. So looking at it and can I, at the moment when I'm in this situation, save less and pay towards my credit card, or just doing it in a measured way, right? So becoming more intentional about how much am I saving? How much am I putting towards my credit cards? How long is it going to take me to do that? Looking at other options for credit card debt, right? Can I roll it over into or consolidate? Or can I get a cheaper interest rate on the debt that I'm currently carrying? So looking at what your options are to make an informed decision about what steps you need to take. So again, that answer is just, it depends, and the answer that I might feel comfortable with, Maggie, you might not feel comfortable with that. So,
Right. It depends.
It depends.
Mm-hmm. Everyone's different. Yep.
Yeah.
Let's say someone has been pretty consistently putting away money towards retirement, whether they have an option through work, like a target date fund or individual retirement plan. How often should someone be reviewing that? And if you have a plan set in place and it's 10 years later, is it something you revisit?
Absolutely. So most things aren't set it and forget it. It would be nice, but it's hugely important to your financial goals. Your life goals change over time. Your life circumstances change over time. So at a minimum, I would say once a year to look at what your investments are. Is it in line with what you're looking to accomplish? If you've created estate, will or any kind of documents, have life circumstances changed, right? Your IRA beneficiary, did you get divorced at some point? Who's your beneficiary on those? And I'll just interject right here that make sure that you're looking at your IRAs and your insurance policies to make sure that your beneficiaries are up to date, because those don't pass through an order of a will. So you might have that you want X person to get your assets at your passing in your will, but if your beneficiary forms on your insurance and your retirement plans say it's Y person, it's Y person that's going to get your assets. So again, hugely important that you're looking at your documents, your beneficiaries, and if life changes have happened, to make sure that you're updating them accordingly.
Okay. Here's a question that came in over chat that says, I work with low-income youth who are starting their first summer job. what advice would you give a teenager to start saving? What percentage of their minimum wage job should they save?
Kudos to you. Thank you. So one of the best advice that I got when I was 20 something, and probably going back to answering your question, Maggie, earlier, of should I save or should I pay down debt, is my first accounting job. My friend said save $50 out of each paycheck, and he had me automate it. So I had an ING account at the time, and every paycheck, $50 would automatically go out of my paycheck. And while I was paying down my credit card debt, I didn't know all the things I knew now at 22 or 23. And that has been the most invaluable lesson for me. So if you're making minimum wage and it's already hard to make your ends meet, if you take $10 out of each paycheck, are you going to miss it? And it might not sound like a lot, right? But let's do $10 times 2. You get 2 paychecks, you're saving $20 a month. Times 12, it's $240. And then you multiply that over time. And I think sometimes we get frustrated when we don't see results fast enough. But this is where savings really happen. When you start putting away small dollar amounts consistently over time, and then don't set it and forget it. Set it, relook at it because your income might go up. Don't allow your expenses to go up at the same time, right? If you can afford to. And start putting away more. So you might start with $10 savings and then move to 15. So the best advice that I would share is no matter how small the dollar amount is out of each paycheck, make sure that you're starting to save, because it's about the dollar amounts, but it's more about creating that habit that will last a lifetime. And that bit of advice given to me at 22, I want to say, has served me well over time, and I share it all the time now.
Mm-hmm. That's great advice. Thank you.
Thank you.
What about someone who is a freelancer? And we talk about the gig economy now. If a lot of the recommendations are use the retirement plan that your company has, and everyone talks about a company match, which doesn't always exist anymore. What are some options for people who aren't necessarily working for an employer? What are some ways that they can still be saving for retirement?
Absolutely. And there are benefits to being in the gig economy, because you're also able to put away, you can create your own retirement fund, right? So whether it's through an IRA or it's called a STEP IRA, so it's self-employed pension, and your income is not as consistent as whether you know that you're going to get a paycheck each two-week period. So when you get larger incomes, it's prudent to put away larger dollar amounts, but also as best as you can create that habit of no matter how much I make, I'm putting away a certain dollar amount or percentage of what my income is. So I had a conversation with an attorney some time ago, and he said someone I think he dated gave him this bit of advice. No matter what his check was from either retainer or whatever income he got, to put away 10% of it, pay himself first. And he did that over time. And he's like, Kaysi, now I work because I want to work, not because I have to. Mm-hmm. And sometimes we don't realize the importance, again, about creating that habit of no matter what the income looks like, if we're able to put away 10% of that, over time, it's that consistency, it's that adding, it's that disciplined approach of doing that will ultimately create wealth over the long term. And that's what a 401k plan does for you, right? It automatically takes it out so you don't have it to spend. So if you can create that vehicle almost for yourself and get into that disciplined approach of saving for yourself first, it will take you a far, far way in both your personal and your financial life.
Mm-hmm. If someone has a 401k through their employer and then switches jobs, what happens with that, or what are some options that they have when changing jobs if they already had a 401k?
Sure. So if you have a 401k and you worked at the company 10 years ago, my first question is who's looking at that 401k plan, right? So now you have money that's out there. You kind of remember it. Nobody really remembers that you worked there 10 years ago. So no one's going to even know where to look for it if something were to happen to you. Best advice is to consolidate. And I know that there are different options. So working with a financial advisor is one of them, and consolidating, and you have more options typically in investments when you do that. Fees are higher, yes, but you're also getting guidance on, you know, what your goals are over time. Another thing that I see other people do is that they might roll it into their current 401k plan, but again, that will limit your options to whatever that current 401k plan is, but at least you know where the monies are. So again, making sure that you're looking at the assets, the investments, and are they still in line with what you're looking to accomplish? Because otherwise, you know, it's more of a headache for you to keep track of monies that are all over the place from different jobs that you've had over time. So best guidance would be to consolidate it into either one place that you can know where it is and it becomes easily trackable, and you're paying attention to what's going on as well with the investments.
Mm-hmm. Okay. I think this might be the last question, but again, if anyone has questions, please use the chat or email info@savvyladies.org. And this question, I think a lot of people think there's some type of magic number or special trick, but when it comes to knowing how much you really should be saving for retirement, what are some tips you have for us? Is there calculations you can do, or just anything to help us better understand sometimes this thing that seems like it's so far away for us, but we know we should be working towards it? If you have advice for really knowing what you really should be looking to save for retirement.
Absolutely. So in terms of a specific number, guess what my answer is?
Yes.
Because my level of lifestyle based on my income and earnings over my career might look very different than yours, right? And so I might have become accustomed to a different, I love to travel, I love to do certain things that may cost money that other people might not want, need to do in retirement. So it's about looking at what your expenses are, especially as you're planning long before retirement. But especially as you're getting closer to retirement, looking at, okay, what are my expenses? Do I still have a mortgage? Do I still need to pay for these things? Do I have the same level of income? And how can I create that stream of income that I once had from a job through my own savings, right? So the numbers are going to look very different based on what your expenses are, what your planned expenses in retirement. And also knowing that no matter how much planning you've done, you can still have something to derail your plan. If you get sick before you're much older, you can have really high medical costs that will eat into your savings a lot quicker. So my best guidance would be to work with a financial plan who's going to create a financial plan for you, but also to revisit over time. It's not one of those things, again, that you set it and forget it just because life changes happen. And then, again, the earlier you start working on this, the more you're consciously making the decision to save more over time as well. I think the simplest way to say this is when you create a goal and you keep it at the forefront of your mind, you're constantly revisiting. How close am I to the goal? How far away do I need to make adjustments? But when you haven't created the plan and you're much later in years, it's kind of harder to make corrections if you haven't done it in the first place.
Mm-hmm. Mm-hmm. Right. Very true. We do have a follow-up question from a previous one asking if you get taxed if you roll over your old plan into your current 401k.
No, there are no taxes on rolling over an asset. So that's the beauty of being able to roll it from one plan to the next. And there are limitations of how often you can roll it over. However, if you were to take it out and have it out for more than 60 days, that's when the taxes would hit. So, make sure it's either going to be rolled over or, but just don't take it out. The time when you have to pay taxes is when you actually take it out of the plan.
Mm-hmm. Okay. Another question that came in over chat is asking if there are some things that low income people can do to save for retirement, assuming that they're already in their later stage in life.
So I think that one is, how can you, so low income, and I think if you knew this question, you probably answered already, right? But are there other ways that you can create more income? So in the absence of income, is there something else? And especially now that we talk about the gig economy and the side hustles, what else can I do that's going to earn me more money so that I can save more and put away more over time? And even if I have a shorter time frame, again, thinking about, will I need to work a little bit longer than I wanted to so that I can take care of what I need to?
Mm-hmm. Okay. Another question on chat is asking if you would share a tip or two when investing in real estate. If someone's looking to live in a house but potentially flip the house, do you have some tips for that?
So to qualify as primary residence, you would have had to live in it for 2 out of 5 years. And then I guess depending on the price and the appreciation over time, whether it becomes a taxable event or not. I don't work as a CPA, I just have the background of it. So, making real estate is also an illiquid asset. So being aware of that as well. And what happens if you can't sell at the time that you would like to sell? So again, making sure that in addition to the real estate on one side, potentially having some kind of more liquid asset on the other side, so that if life were to happen and your tenant's not paying, I've had that situation, your tenant isn't paying, that you're still able to pay the mortgage without running into or potentially losing your home as a result.
Mm-hmm. Okay. Kaysi, those look like all the questions that we have. So I wanted to just give you a chance if you had any closing advice or words of wisdom for us.
No, I think the best advice, and I think I saw something that popped up that says tip for starting a budget. Start where you are, look at what your expenses are, and then create some kind of guideline based on that. And as best as you can, live within the budget and making sure that you're revisiting over time. Start small, no matter where you are. That would be my guidance. No matter where you are, start small and start putting away any amounts that you can. If there's a match to be had in your retirement plan, make sure that you're getting it and not leaving anything on the table. Because over time, these are the small changes that make the hugest differences for you.
Mm-hmm.
And also work with a professional who knows what they're doing, especially depending on where you are in your phase of life. Some people think they can't afford a financial advisor, but in some instances, you actually can't afford not to have a financial advisor.
Mm-hmm. Yes. And so Kaysi's contact information is here. And Kaysi, did you just want to talk about the schedule a call? If anyone's interested, we'll share this link. Is that for a 30-minute?
Absolutely. So there were a few questions on here that I didn't know enough of the circumstances to be able to share. So I'm happy to get on the call with you. And for those who had questions who were shy to ask them, I'm happy to have those conversations as well. I just believe it's the guidance that I got at 22, as I've referenced a number of times, that is allowing me to do the thing. So if I can do that, my birthday was yesterday, so this is my way of sharing and giving back what I've learned over time.
Thank you. Happy belated birthday, Kaysi.
Thank you. Thank you.
Thank you so much for for having a conversation with us today and answering all of our questions. And I want to thank everyone for joining us today. We'll be sharing this information in a follow-up email, and I'm just seeing some messages come in over chat thanking you, Kaysi. So again, thank you so much for taking the time to walk through this with us today. It was really very, very helpful, and it was fun too.
Thank you. It was really my pleasure as well.
Great. Thanks. Thanks, everybody. Bye-bye.